In this video, I will be talking about accounting for equity securities when there is significant influence or effective control. Recall from the last video that accounting for equity securities depends upon how much influence the buyer can exert over the activities of the share issuer. Today we will be talking about significant influence and effective control, starting with significant influence. Significant influence is typically considered to be 20 to 50% share ownership, but as mentioned in the last video, it is possible to exert influence that is disproportionate to the shares owned. I said we'd talk about that later. It's not later yet. So let's say that I own 20 to 50% of the outstanding shares of Apple. Now will Tim Cook take my call? Okay, and is he going to do whatever I tell him to do? Right. So I can put my 2 cents in and be heard, but I don't have any decision-making rights for Apple. In this case, we are going to use the equity method to account for our investment. We will record our investment at its purchase price or historical cost, and then adjust the investment's value anytime the company we invested in reports a profit or loss or pays dividends. We will treat this account as a mini retained earnings for our share in that company. If that company reports a profit, we will increase the value of our investment by our share of the profits. If the company pays dividends, we will decrease the value of our investment by the cash paid out to us. Just like we would adjust our own retained earnings account when our company made a profit or paid out dividends. Let's look at the example. In this example, we have Zoop Corporation purchasing for $300,000 a 30% interest in Murphy, Inc. This investment enables Zoop to exert significant influence over Murphy. During the year, Murphy earned net income of $180,000 and paid dividends of $60,000. They'd like us to prepare Zoop's journal entries related to this investment. So the first thing we need to do is record the purchase of our investment. So we don't need to know much for this. We don't care if it's a debt security or an equity security. We don't care how much influence we can exert. This is going to be the same no matter what. So we paid cash out the door, so we're going to credit cash to decrease that asset account for the amount we paid, which is $300,000. Then we're going to debit what we got, which is an asset that we are adding to our books called equity investment. Also for $300,000 or our original investment amount. Now what we do from here, we do now care what kind of investment this is. So we know it's an equity investment because we bought stock in another company. And then we need to know how much influence we have. So they specifically told us that we have significant influence over Murphy. So that means we're going to use the equity method. The equity method says that we are going to adjust our initial investment anytime our company we've invested in reports a profit or loss or pays out dividends. So first thing we need to figure out is, did they report a profit or a loss? And so they tell us that they reported net income of $180,000. So that's a profit. They were profitable in the last year. So anytime our investment company earns positive income, that's going to increase the value of our investment. So we're going to debit equity investment to increase the value of that account. Now the amount is going to be that $180,000 that they reported as net income, but only our share of it. So our share is 30% because we own 30% of the company. So that's going to be an increase to our investment of $54,000. Now the offset to this is going to be investment income. So we're going to credit investment income. But I'm also going to put another account name here because in this class we use 2 different books that we've combined into a custom book, and the sets of authors use 2 different names. So in the book we are currently using, they call this investment income, but later when we switch books, they're going to call this equity in S income. So I'm just going to make sure you know both names. For right now, you can use either. I think investment income is more clear, but when we get to the homework for later chapters, they might switch to equity and S income on you. Okay, so we're going to record investment income of $54,000. Then the other time we're going to record something under the equity method is if our subsidiary or if our investee pays out dividends. And so in this case, they paid dividends of $60,000. So dividends are just a cash payment to the shareholders. So that means we are literally going to get cash. So our debit is cash. And how much of those dividends are going to come to us? Well, they paid $60,000 in total, and we own 30% of their shares, so 30% of those dividends are coming to us. So that's an $18,000 check we can expect in the mail. Then our credit is going to be equity investment. So remember, I said that if they pay out dividends, that's going to decrease our investment account. So that's a credit to equity investment. So again, you can see it follows the same principles as our retained earnings account. So when we report positive income, our retained earnings goes up. When we record a loss, our retained earnings goes down. When we pay out dividends, our retained earnings goes down. So we're going to use this account in the same way as we use our own retained earnings. When our subsidiary makes income, our equity investment is going to go up. If our subsidiary reports a loss, our equity investment is going to go down. And when they pay out dividends, our investment is also going to go down. Next, we're going to talk about effective control. Effective control is typically when we own greater than 50% of a company's outstanding shares. However, it is possible to exert influence that is disproportionate to the shares owned. It's still not later yet, but I promise we will revisit this concept. For now, look for the words little or no influence, significant influence, or effective control. If those words aren't present, then we can rely on the percentage cutoffs, but the qualitative thresholds trump any quantitative ones. So, if I own 60% of Apple's outstanding stock, is Tim Cook taking my call and listening to what I have to say? Right. So we have effective control over Apple by occupying the majority shareholder role. When we have effective control, the accounting method doesn't really matter. This is because we are going to be required to consolidate our financial statements with those of the company we own shares in. This process will wipe out any accounting we did on our books, either using the cost or the equity methods, and we'll end up in the same place. The good news is that we're not going to learn how to do this right now. The bad news is we're going to learn about it in a week or two from now, so stay tuned. This concludes our lecture on significant influence and effective control. Don't forget to email your questions for our discussion.